Hey there, welcome back to Bizdateup. In our previous episode, we spoke about the differences between safe notes and convertible notes. But did you exactly understand the term safe notes? Okay, we've got you. In this video, we're going to talk about safe notes and all that you need to know about them. For starters, a safe note is a contract between a startup and an investor that grants the investor the right to possess future ownership in the firm. Safe notes are a more sophisticated type of convertible security, but they are not any type of debt. These safe notes have been gaining momentum in India since 2019, when a Mumbai-based venture capital firm chose to use safe note instrument to invest in 90+ high-growth firms over the course of a year. Safe notes in India are legally known as compulsorily convertible preference share (CCPS) and are controlled by Section 42, 62 and 55 of the Companies Act 2013. Let's dive in deep to understand the concept of safe notes better. A safe note enables a startup to make an investment that will later convert into equity. To understand safe notes better, one must completely be thorough with convertible notes. Don't know what convertible notes are? Watch our previous video to get a better understanding. A safe note is a convertible security with the exception of a loan and interest rate. This eliminates the need for the creator to be concerned about the coming maturity date and repayment of the interest rate. How do safe notes work? Uncertain startup valuations and a pressing need for finance led to the use of safe notes. Point number 1. In India, the startup should be registered with the Department for Promotion of Industry and Internal Trade as a private business under the Act. Point number 2. The investor and the founder agree that the investor will contribute the initial funds to begin the gears of the wheel, turning in return for future shares. Point number 3. The entrepreneur may now utilize the funds to fund various elements of their business, including employment and product development, and probably many more. Point number 4, the founder may require additional resources after making certain development. The firm receives a post-money value whenever another investor agrees to invest in the pricing round. And point number 5, and the last one, the new price per share is computed after that. Is the safe note agreement applicable to any startup? Your firm must be included in the C Corporation capitalization table to employ a safe note arrangement against being a limited liability company. Simply explained, a C Corp is a corporation with a board of directors or management that gets taxed twice, earnings and salaries, instead of having one or more owners. LLCs have several partners or members. CA certificate of incorporation and a cap table are typically included with corporations. A capitalization table is simply a listing of which entities possess which assets, such as stocks and shares. Benefits of using safe notes. Simplified, these contracts are easy enough for anybody to grasp and are only 5 to 6 pages long. Interest rates and maturity dates are not mentioned. Useful agreements. All legal stipulations regarding future occurrences such as bankruptcy, change in ownership, dissolution of business itself, early departures of any party, discounts and valuation caps are included in safe note agreements. No accounting horror. The starting cap table always includes safe notes. As a result, the possibility of tax-related repercussions is almost eliminated. Negotiations. These contracts have straightforward terms with very less restrictions. This saves time and makes them easier to comprehend, especially for rookie businesses. Flexibility. The creator has more control over safe notes because they are not debt instruments. The founder knows what to anticipate from the arrangement in the future and has complete control, as opposed to the convertible notes which carry 2 to 8% interest rates on the debt. More choices for the investor. Discount and valuation caps safeguard investors' interests by incentivizing them to finance more in order to keep their shares. Drawbacks of using safe notes. Risks. There is no certainty that the safe note investment will never reach the stage where it can be converted into equity. Revenue issues. investors may be put off by the lack of interest payments because they believe their earnings will be lower in the long term. Mandatory incorporation. When an LLC seeks to reorganize itself to become a C Corp in order to comply with a safe note arrangement, it spends a lot of time, energy and money on legal expenses. Dividends. Dividends aren't really paid to safe investors as compared to profits of other kinds of investors to get when the company is performing very well. In this case, the safe investor's only incentive is the promise of stock. Here's all that you need to know about safe notes. These safe notes will make the process easier for not only the big ones, but also the young minds to adapt to these. See you in the next episode. Till then, you can reach out to us on Bizdateup.com.